Hello, and welcome to the White Feather Investment Finance Module. My name is Julianne Peterson, and I am a commercial loan officer for Old Capital Lending. Over the next 25 minutes or so, we're going to talk about the differences between single-family financing and multifamily financing. But a little bit about us. Old Capital was started 31 years ago. We've closed $1 billion each year, 2018, 2019. We've closed 5,800 loans. We do primarily our agency debt, which is your non-recourse debt. We do bank, we do CMBS, we do bridge lending. A little bit about me. I've been in business for 30 years as an owner operator here in San Diego, as well as in California, in the Bay Area, in Chicago. Today, I find myself as an investor on a limited partner, 1,500 units in Texas, in Kentucky, and a shopping center in North Carolina. I'm also a mother of 4 kids and a wife of 24 years to my husband, Robert. We also do the Old Capital podcast. We've got 65,000 listeners now. This is rated the top 5 for podcasts. We sit down with real live investors every week to hear what their experience is in multifamily. These are the asset classes that we get involved with. 85% of our business is done in multifamily. But there are other great asset classes that take on commercial lending. These are a couple of them. We spend a lot of time, again, in multifamily, but there are opportunities in student, in senior, in retail, office, industrial, mobile home park, great asset class, and office. So today, let's talk about single family finance versus multifamily. And if you're new to this asset class, this is what it must look like or feel like. It's not as complicated as you might seem. Now let's talk about single family finance. First and foremost, when we look at single family, this is recourse lending. What does recourse lending mean? Take for an example of a banker that says, hey, what's your FICO score? How much money do you have in the bank? How much money do you earn? I am going to, as a lender, take my hand and reach into your pocket and ask for your wallet. And I take control as collateral of your, a portion of your balance sheet to pay for that asset. We also do not require in single family any experience necessary, kind of like being a parent. You don't need to have any experience to have little kids. Same thing with single family finance. There are no net worth requirements. There are no liquidity requirements. It is a personal asset. Many times you're buying your personal home and maybe you decide you want to leave and you want to rent it out. Then it becomes a business asset. You've never been a landlord, but you turn it into a business asset. And many of us have single family finance with the owner occupied, and then you turn it into a business. Or you might take out a loan as a single family loan. However, it's a business. So at that point, you need to talk to your lender and tell them what you're going to do, if you're going to do a fix and flip, if you're going to end up having tenants. In some cases, if you're buying it already leased up, you're going to need to provide leases. This is considered possibly a business transaction, but you're still using single family lending. So the requirements are a lot less, a lot easier to get through. Many times you'll find, depending on your FICO score or your credit, how much you have taken away on your credit as for credit cards or for cars, you have some purchasing power. Sometimes you can get 70, maybe you'll get 80% leverage. When you take out this loan, it is a principal and interest payment. You start day one making the same payments day one as you do on payment 30 years later. This is called fully amortized over the whole bank loan. Sometimes you have 15 years amortization, sometimes you have 20. Most of the time we see 30 on single family financing, but it's fully amortized. You don't get any interest only timing. Also, you don't get to roll in any of your rehab. So what does that mean? You have to take out maybe a second loan. Maybe a HELOC will take care of a second on that, and then you can put your rehab dollars into it. In single family, that is the great thing on the second lien on the property, not so much in multifamily, which we'll talk about. There are no profitability reports or requirements that the bank will have on single family financing. Now, I told you you might need to show the leases, but beyond that, it's pretty simple. Also, there are no prepayment penalties. 30 years ago, when I bought my first property, if I got out in a certain amount of time, I had to pay. Now, these days, there's no prepayment penalty. You can take on a 30-year loan and get out after the first year. The application fees are very cheap, if not free, depending on the lender. Not so much in multifamily, which we'll talk about. There's a cheap finance appraisals. So the appraisals are based on the comps. So maybe you have a pool, maybe you have blue paint that maybe is not a good value. Your neighbors have a really nice landscaping, front yard landscaping. Yours not so much. So they're looking at the comps, and that's where you get your value from. And then lastly, you have an appraiser that looks at the underwriting, or actually at the value, and you also have an underwriter that is looking at not only the value of the property, but also evaluating you. That's single family. Now let's transition to multifamily. A little bit more complex, not so much like the picture showed, very, all of the math equation. But here is non-recourse lending when we talk about agency debt. And for the focus of this conversation, we're going to talk about agency debt. That is non-recourse lending. You can sign on the line. You don't have to look at if you have a low FICO score, you can still sign on the loan. This is called non-recourse lending. You can purchase 100 unit here, 200 units here, 50, 250. You can leverage your ability to purchase on your net worth and liquidity, or your people that are on your team. So if they've got large net worth and you're signing on the loan, you have the ability to purchase a lot of multifamily. So let's get into this. Experience is key in non-recourse multifamily finance. What does that mean? So we're going to look for someone on your team, in your group, that has experience in Fannie and Freddie financing, in non-recourse financing. They're going to look for 2, 3, 4 opportunities that they've been in that will allow them to sign on the loan. Also, we're looking for net worth and liquidity requirements. On agency debt, you're looking at, on net worth, it is greater than the amount of the loan. So if you've got a $1 million loan amount, you're going to need net worth of greater than $1 million. In liquidity, we're going to look for 10% of the loan amount. So on a $1 million loan, we're going to look for $100,000 in cash, marketable securities, your life insurance policy, the cash value of that. So when we are starting our conversation, we're going to look for your personal financial statements of all of the folks on your team. We're going to look for your schedule of real estate. We're going to look for a resume of your experience. And when you're looking for partners to put on your team, I recommend finding the most qualified high net worth individual as you can. That will take one place, one person that will take that spot. Now, certainly you can find someone who has net worth. You can find someone who has liquidity and another person who has experience. But let's face it, the more people that are on your team to provide those boxes to check, the less money goes in your pocket. So if you can find a high net worth individual, that's going to be key. Secondly, these are business assets. These are performing assets. Well, at least we're hoping so. So as opposed to single family that was owner occupied, we are going to look at the performance of this asset, and that's how we're going to base our financing. We're going to base our leverage. We're going to base on the debt service coverage, how this property performs. In multifamily, as I've talked about in the past, we're looking in the rear. We're looking at the profit and loss statement, your T12. We're going to look at T3, so the last 3 months, T6, and maybe 9, and as well as 12. How is this asset performing? That's going to be how we base how much money, how many loan dollars we give you. There's also an occupancy requirement. On Fannie Mae and Freddie Mac, we require on these non-recourse debts, we require 90% occupancy for 90 days. That's your T3. We're going to look at that. If you have less than that, it's going to be considered a non-stabilized asset. Stabilized assets equal 90 days occupancy, 90% occupancy for 90 days. If it doesn't have that, that's considered unstabilized or distressed asset, and you'll be looking at a different type of loan. But for our conversation today, the occupancy for Fannie and Freddie agency loans are going to be 90% occupied for 90 days. This will allow us to look again at the performance. Are we going to be able to get you, based on that performance, 70 to 80% leverage? You're going to need to make up the other for a down payment, and from your GP, your general partnership, we're going to look for you to bring in 5 to 10% of that down payment. The rest of the syndication model, they would bring in your investors that would be considered limited partners, will bring in the rest of that down payment. But from the general partnership, we're going to look for 5 to 10% of that 25% down payment. With these the types of loans, we also give you interest only. Can you imagine? You get interest only from 1 to 3 years. Now, there is the ability with lower leverage to get more interest only, but for this conversation, 1 to 3 years, interest only, amortized over 30 years. And then these loans are actually shorter term loans, 3, 5, 7, 10, 12, 15. At the end of that term, so at the end of 10 years, you have a balloon payment. Now, the way that the syndication model is we typically don't go all the way to 10 years, or if we are going all the way to 10 years, we may say we're going to sell it at 10 years, or it's going to be a legacy asset. In that case, we're going to take on another loan and refinance into another loan. But typically, this model of syndicating this type of asset, you're going to look for the IO, interest only, for 3 years. You're going to do your rehab during that time period. You're going to, because you're taking on only, or you're only paying interest only, you'll be able to make dividends to your investors in that first 3 years. The 4th year, the 5th year, it's going into principal and interest payments. Their distributions will be lower, but that will all be explained when you get your investors on board. And then typically what we have seen in the past is 5 to 7 years is when we go ahead and sell these types of assets. There's also the ability to roll in the rehab, not like a second HELOC on single family, but you can actually get an 80% loan to value, LTV, loan to value. You can get a loan for that, and then you can have them put into the loan an additional, let's say 200,000, 500,000, based on the experience of that GP of your partner in the deal, we will give you this rehab. Now it goes, then shifts from loan to value into loan to cost. So it gives you the ability to borrow more money based on that performance of that asset to do your rehab. It's a great, great option in these types of loans. The other thing that I wanted to talk to you about is we talked about the second over at the HELOC, that you can bolt on a second on single family, but we call them a supplemental. We'll bolt on a second or supplemental in this asset class. And what that allows you to do is you can cash out, if you will, cash out your investors and then carry the asset to the maturity date. Now, maybe you hold on to this asset, or you refinance it, or you sell it. Depends on what your business plan is. But that supplemental loan will give you 75% on the appraised value to get more money and then release those investors. These again are based on, these loans are based on your net operating income. That allows us to look at how much money is the property bringing in, what your expenses are, and once we look at, when we put in the debt service for that mortgage, is there enough coverage of the net operating income? And we usually require 1.25. So what does that mean? Well, 1 would be considered I can make the payment, but I have nothing left. I have no money in left after paying those bills. What we ask for is 1.25, meaning you've got about 25% over collections over that payment, that mortgage payment. So that's a requirement that you don't see in single family. There's large prepayment penalties. So when you and I get together and we talk about the business plan, again, before you put in your LOI, which we'll talk about later, is that we're going to try and figure out what your business plan is and how my loan, we can put on a loan that I can provide to you, will be the best solution to return the best amount of distributions to your clients. That's all going to be upfront. Now, the cheapest is a yield maintenance loan. That's going to be held for 5 years. It's going to be held for 7 years or 10 years. But maybe you want to get out early. It may make more sense to take on a step down prepayment, because you could take out a 10-year, but you know that you're getting out in 7. You use this prepayment, this step down prepayment option, and then you know exactly how much it's going to cost you to get out. With yield maintenance, you really don't know how much it's going to cost you to get out. So we'll talk a little bit more about that when we in another module. It is expensive. These loans are expensive, that you're going to need to bring in capital once you apply. So your first amount of money will be about $10,000, which you'll need to bring in after you get your PSA, which is that's your sales agreement. All right. So 10,000 and as much as 50,000 to get into this application fee. Okay. And that will trigger these third party, the appraiser, the engineering, and environmental. You don't have those on single family. In multifamily, you do have these different third party providers that need to get launched with that application fee. Lastly, is the appraisal is based on the performance. Again, we don't have that so much in single family. I wanted to show this to you so you can compare the two side by side. If you want to take a picture now, this is a valuable slide for you so that you can understand the differences. Now, I want to review with you one more time when we talk about multifamily agency non-recourse loans. This is the requirement. First and foremost, net worth above greater than the loan amount. Secondly, liquidity. About 10% of the loan amount is required. Cash, marketable securities, no 401k, IRAs. Third is experience in multifamily. If you have 400 single families, there are loans out there that we can get you into. There are some guidelines that we'll talk about. And then lastly, we talked a little bit about this, equity. Coming from the GP, the general partners, the folks that are on your team will need to bring 5 to 10% of that down payment, okay? Once you have this team, then you can go out and look for properties. So when do you engage, Julie, when do you engage a lender? It really is important to get to us before the LOI. As you can see here, before the LOI, before the PSA, your sales agreement, come to me. Let's look at the financials. Let's have a conversation on what your goals are, what your business plan is. Here we'll just step you through how that process looks. You'll have the application. That's when you put your $10,000 down. We engage the third parties. We then are collecting a lot of information from you. It goes into underwriting, and at that point, we can get an understanding of, are we going to get this approved? What is the extra details that we're going to need to come from the seller or from the buyers? At that point, on a Fannie, you're going to receive a term sheet, and the term sheet will tell you exactly what the loan details are. On Fannie, this is how this works. On Freddie, the loan application, at time of application, your $10,000, you will then sign on it and you will lock in the terms of the loan. So if you're in a situation where you need to be confident, there's no wiggle room, you are confident in your underwriting and the loan cannot change, I would recommend Freddie, and we will talk in future modules about that, that product. And then lastly, about 3 to 4 days on a Fannie loan, you're going to get this term sheet and then we're going to close about 3 days later. So this is how it works from start to finish. So moving forward, what do you need to do? We always say start with education. Figure out all the information about multifamily properties, lending, tax requirements, tax solutions. This is the time to do it. Then you want to make sure that people are on your team, have the qualifications, you start underwriting, and then you start to make offers. And once we have that, we can walk you through that, and then we close the deal. So, do you have any questions? Is there anything that I've covered so far that you're not clear with? Go ahead and give me a call, send me an email. I am here to answer your questions. I'm happy to jump on a call. Let me know how we can help at Old Capital Lending. Again, my name is Julie, Old Capital Lending. I look forward to our next time we can meet.